This woman was hit with a $660,000 tax bill when both of her parents died in the same year. Actually, her parents' estate, not her personally, but of course her inheritance gets substantially reduced because of this. Now, when her mom passed away first, all of her assets gets rolled over to her husband. So this woman's dad had over $700,000 in RSPs. Now, when he passed away, all the assets go to their children. And so what happens is when you pass away, all of your assets are deemed disposed of, which means you assume everything is sold on the day that you pass away. In this case, a $700,000 RSP account, half of it gets taxed because that gets added to your income. And the entire amount being on your income line, it's very hefty. That pushes you into the highest tax bracket. And on top of that, they had a cottage. It was purchased in the 90s, even though 5 years prior to their death, they moved in and that was deemed their principal residence, but they still had to pay a capital gain on it because at some point their cottage was their secondary property. All of these taxes come out of the estate. And to avoid having to pay cash taxes on a very hefty tax bill, things like the use of an insurance policy would have been helpful because insurance proceeds are paid out tax-free. Another strategy they could have used, melting down some of the RSPs earlier so that they avoid a one-time massive tax hit. They made no mention of TFSAs. It's even worth it to pay the upfront taxes by withdrawing money out of your RSPs, put it in your TFSAs, and then continue tax-free growth. And because they wanted to keep the cottage in the family, they didn't want to sell it in order to pay the tax bill. The money will have to come from the RSPs after it's already been taxed. This is why it's important to have proper tax planning, estate planning, so that there are no surprises when the tax bill arrives.